Are you looking to build a diversified portfolio but unsure where to start? The first step is defining your goals. The cornerstone of any successful investment strategy begins with understanding what you want to achieve financially. Do you aim for a comfortable retirement, buying a house, or perhaps funding your child's education? These are just a few examples of financial goals that can shape your investment decisions. Understanding your risk tolerance is equally crucial. Are you a risk taker ready to weather market ups and downs for higher returns? Or perhaps you're conservative, preferring stability over potential high gains. Your stance will significantly influence the type of investments you'll consider. Lastly, consider your investment horizon. Are you investing for the short term, or are you in it for the long haul? This will guide your decisions on the type of assets to include in your portfolio, balancing between growth and stability. Remember, a well-defined goal is the first step towards building a diversified portfolio. Now that you've defined your goals, let's talk about asset allocation. This is the process of spreading your investments across different asset classes. Think of it as not putting all your eggs in one basket. The major asset classes include stocks, bonds, and cash. Each of these classes behaves differently over time, and they each carry their own levels of risk and reward. So how do you decide what proportion of each to include in your portfolio? Well, that's where your goals, risk tolerance, and investment horizon come into play. If you're aiming for higher returns and can stomach a bit more risk, you might lean more towards stocks. On the other hand, if safety and stability are your top priorities, bonds and cash may make up a larger portion of your portfolio. Remember, there's no one-size-fits-all approach here. Your asset allocation should be as unique as your financial goals. Achieving the right balance of assets is a critical step in portfolio diversification. Diversification doesn't stop at asset allocation, it extends to stocks and bonds too. It's like a game of chess. You wouldn't place all your pieces in one spot, would you? The same logic applies to your portfolio. When it comes to stocks, it's wise to spread your investments across various industries, sectors, and even geographies. Think about it this way. If you invest solely in tech stocks and the tech industry faces a downturn, your portfolio will bear the brunt of it. But if you diversify, say by including stocks from the healthcare or energy sector, the impact of the tech downturn on your portfolio could be cushioned. Similarly, investing in international stocks can provide a buffer if your home market faces a slump. This way you're not putting all your eggs in one basket, and that's the beauty of diversification. Now let's talk about bonds. Bonds can be a safe haven, providing stability and income to your portfolio. But not all bonds are created equal. You have government bonds, corporate bonds, and municipal bonds, each with their own risk and return profiles. Spreading your investments across these different types of bonds can help manage risk. But there's another layer to bond diversification: duration. Bond prices are sensitive to interest rate changes, and this sensitivity is measured by a bond's duration. Long-term bonds have higher durations and are more sensitive to interest rate changes, while short-term bonds are less sensitive. So, by diversifying across both short and long-term bonds, you can better navigate the ebb and flow of interest rate changes. It's like a symphony, where each instrument plays its part to create a harmonious melody. In your portfolio, each stock or bond from different sectors, industries, or geographies plays its part to create a resilient, well-rounded investment strategy. Remember, diversification doesn't guarantee profits or protect against losses, but it can help you manage risk and potentially enhance your returns over time. So, whether you're a seasoned investor or just starting out, consider diversifying within your stock and bond investments. Diversifying within stocks and bonds can cushion your portfolio against market volatility. Beyond stocks and bonds, there's another asset class to consider: real assets. Real assets include tangible investments like real estate, commodities, and collectibles. These assets are unique because they have intrinsic value, meaning their worth is tied to their physical properties. This can provide a hedge against inflation and currency fluctuations, as their value doesn't depend on financial markets. Consider a piece of real estate, for instance. Its value is tied to factors like location, demand, and the physical condition of the property, rather than the ebb and flow of the stock market. Similarly, commodities like gold, oil, or agricultural products have value based on their practical uses and global demand. The beauty of including real assets in your portfolio is that they can act independently of traditional stocks and bonds. They offer a diversification benefit, as they may perform well when other asset classes are underperforming. Real assets offer another layer of diversification to your portfolio. Now, let's take our diversification strategy global. Geographic diversification is the practice of spreading your investments across different regions of the world. This can help mitigate the impact of economic downturns in a specific country or region. Think of it as not putting all your eggs in one basket, but rather, in several baskets around the globe. Why is this important? Imagine a scenario where a particular country is facing an economic crisis. If all your investments were concentrated in that one country, your portfolio would take a significant hit. But if your investments are spread across different regions, the impact on your overall portfolio would be less severe. This strategy isn't just about protection, it's also about opportunity. By investing globally, you expose your portfolio to growth opportunities in emerging markets that you might otherwise miss. So in essence, geographic diversification can help protect your portfolio from regional economic downturns and also provide opportunities for growth. Building a diversified portfolio isn't a one-time task. It requires regular rebalancing and risk assessment. Let's dive into the realm of portfolio rebalancing, which is essentially the process of realigning the weightings of your portfolio of assets. Rebalancing involves periodically buying or selling assets in your portfolio to maintain your originally desired level of asset allocation. Think of it as a tune-up for your investments, to ensure they're performing at their best and still aligning with your financial goals. Changes in market conditions can cause your portfolio's asset allocation to drift from its target. For instance, if stocks have performed well during a certain period, they might come to represent a larger portion of your portfolio than you had initially intended. Rebalancing lets you reset your portfolio back to your target allocation. Rebalancing isn't just driven by market changes though. Personal situations can also call for a rebalance. Major life events, changes in your financial goals, or shifts in your risk tolerance can all warrant a revisit and possible adjustment of your portfolio. But rebalancing isn't the only constant in this journey. Risk management is another critical aspect that requires ongoing attention. There are various risks to consider, including market risk, credit risk, and liquidity risk. Market risk involves losses due to factors that affect the overall performance of the financial markets. Credit risk is the chance that a borrower will default on any type of debt by failing to make required payments. And liquidity risk, that's the risk of not being able to quickly convert assets into cash without a loss in value. Each of these risks can impact your portfolio in different ways, and it's important to factor them into your risk management strategy. A well-rounded strategy will consider all these risks, and determine how best to mitigate them in line with your goals and risk tolerance. Regular rebalancing and risk assessment are crucial for maintaining a diversified portfolio. It's not enough to set it and forget it. The key to a healthy, diversified portfolio is regular maintenance and a keen eye on risk. Diversification isn't just about what you invest in, but also how you invest. Imagine you're on a journey. You wouldn't want to rely solely on one mode of transportation, would you? Similarly, your investment journey should not be confined to just one type of investment vehicle. Instead, utilize a mix of mutual funds, exchange-traded funds, or ETFs, and individual stocks and bonds. Let's take a closer look. Mutual funds are like a bus filled with various passengers, or in this case, a variety of investments managed by a professional. This vehicle gives you a diversified portfolio in one neat package, taking some of the heavy lifting off your shoulders. Then we have ETFs, which are akin to a self-driving car. They offer the same broad diversification as mutual funds, but with the added flexibility of being traded like individual stocks. This means you can buy and sell ETFs throughout the day at fluctuating prices. And finally, there are individual stocks and bonds. Think of these as your bicycle or walking shoes. They offer the most control, but also require the most effort and carry higher risk. However, when chosen wisely, they can greatly enhance your portfolio's potential. But remember, the journey doesn't end with choosing your vehicles. You need to stay informed about the terrain ahead. This means keeping an eye on market trends, economic indicators, and global events. The investment landscape is dynamic and ever-changing, so it's crucial to adjust your portfolio accordingly. Think of it like a GPS. It's not enough to set your destination at the start of the journey. You need to keep checking it, recalibrating your route based on traffic conditions, roadworks, or new shortcuts that come up. Similarly, regularly reassess your portfolio in light of any changes in the investment world. This will ensure you stay on the right track towards your financial goals. Using the right investment vehicles and staying informed are key to effective portfolio diversification.